I'm going to give you 5 reasons why in 2025 you'll not only survive, you will thrive. Good morning, this is Jim Perry at Perry Capital. Those 5 points: policy, the economy, Fed, markets, and portfolio construction. Pretty simple. Let's talk about policy first because that's what's on everybody's mind. Number 1, taxes are going to go down. That's going to help corporate profitability and spending. Number 2, regulation is going to go down. That's going to help corporate profitability and consumers. Number 3, the trade deficit is going to go down. It's $1.7 trillion right now. And what's interesting about that is that the U.S. has currently in place tariffs which are at 2.4%. All right, the global average is 6.5. If we just get to 6.5, the average amount of tariffs collected by the U.S. government has been $70 billion a year. So going to 6.5 from 2.4, that's $5 billion. That's not a lot. Tariffs are not going to be inflationary, and they're not going to harm the U.S. economy. And I think that the confusion that people have is they look at it politically rather than economically. All we have to do is start getting that deficit number lower. Second thing, budgets. It's $2 trillion on the deficit side, all right? All we got to do is cut some spending. Maybe it's $100 trillion in the first quarter, maybe it's 2. We'll know more on the 20th. But the key thing is cutting spending will reduce non-productive assets with no returns and bring that money into the private sector. I have a strong conviction that that's going to be very, very good for the economy. Markets, same thing. What's going on in 24? Same thing's going to go on in 25. Big cap hyperscalers are going to continue to gain in profitability and market share, and the Mag 7 probably becomes the Mag 8 because Broadcom is our latest $1 trillion company. So let's talk about policy and spending first. Randall Forsyth, great writer for Barron's, talked this week about Moody's Investors Services possibly downgrading the AAA rating that they have on U.S. debt to a lower number. In November of 23, they lowered the outlook for U.S. debt to negative, still holding the AAA rating. In that press release, Moody's said, and I quote, "Continued political polarization within the U.S. Congress raises the risk that successive governments will not be able to reach consensus on a fiscal plan to slow the decline in debt affordability. This is the issue. Spending cuts are the issue for the economy and markets this year. If we can do that, interest rate expectations will go lower because inflation expectations will go lower. If we continue to see a Fed, which is stimulative, they've cut 100 basis points since September, and the bond market at the same time has gone up in yield by about the same amount. The market is telling you that inflation is a bigger problem than growth. I believe that to be true. If inflation goes down, it will be because spending goes down. I think that the economy and the markets are telling you that the Fed stimulus is not necessary for the strength in this economy. The economy is doing great. Consumers are in great shape. That's the biggest portion of the economy. Incomes are high. Employment is high. Stock market's at all-time highs. House prices are at all-time highs. Automobile sales, which came out Friday, were 16.8 million units. That's the highest in about 10 years. Debt levels are low. Interest rate sensitivity is low, and banks are more willing to lend. So I think there's plenty of stimulus in the economy domestically. It's being helped by stimulus in the global economy. The U.S. economy is stronger than most people think. I think that with lower taxes and regulation and a reduction in spending, you're going to see inflation expectations fall. I think interest rates will follow. The U.S. economy will do well, and the stock market will too. Good luck in the new year. The new year starts this week, tomorrow, and I can't wait to see what's going to happen because it's going to be really exciting. I look forward to it. Have a good rest of your weekend, and I'll talk to you next week. Thanks a lot. Bye.